Hello, everyone. My name is Diego Manco, and today I will analyze financial transactions behind the movie Avengers Endgame using basic accounting principle. For this entertainment example, I selected Avengers Endgame, as I already said, produced by Marvel Studios and distributed by Walt Disney Studios Motion Pictures. This movie was released in 2019 and became one of the biggest financial success in film industry. It estimated production budget was around 356 to $400 million, and it earned around almost um, $2.8 billion worldwide and in box office and at the box office. First transaction payment. In the payment of the production costs, three costs include actors, directors, crews, and sets, visual effects, costumes, and post-production. From accounting perspective, the studio would not immediately treat all of this as a regular expense. Since the film is expected to generate future revenue, the cost can first be recorded as a film production asset. The journal entry would be Dr. Film Production Asset, 400 million, CR Cash, 400 million. This means that cash decreases, but another asset increases. The accounting equation stays equally balanced because total assets do not change overall. One asset is exchanged for another asset. The second transaction is recording theatrical revenue. Avengers Endgame earned almost $2.8 billion worldwide, but Disney would not record the full box office gross as its own revenue. Theaters keep a portion of the ticket sales, so the studio records only its estimated distributor share. For this example, I will assume Disney receives about 50% or $1.4 billion. The journal entry would be DR cash or accounts. The receivable is $1.4 billion, and the CR theatrical revenue will be another $1.4 billion. This increases assets through cash receivable and increases equity through revenue. Um, And the third transaction is it's paying marketing and distribution costs. A major movie like Endgame requires trailers, posters, commercial, press events, and global promotion. For this example, it will estimate a marketing and distribution cost at $200 million. The journal entry would be DR marketing expense, $200 million, and CR cash, another $200 million. This reduces cash, which is an asset, and also reduces equity because expenses lower net income, of course. In terms of accounting, as you can see in the screen, of the accounting accuracy, one common mistake is saying that Disney earned the entire $2.8 billion as revenue. That is not accurate because the box office gross is not the same as the studio revenue. Theater and international distributors kept part of the ticket sales. A better accounting correction is record only Disney's estimated share. Another correction is related to production cost. It would be inaccurate to treat all production spending as an immediate expense before the movie generates revenue. Instead, those costs should be capitalized as a film asset and then amortized as the movie earned revenue. This follows the matchmaking principle because expenses should be matched with the revenue they help create. Overall, um, Avengers Endgame is a strong example of how accounting principles apply to the entertainment industry. The main transactions are productions investments, theatrical revenues, recognition, and marketing expenses. Each transaction follows the accounting equation assets equal liability plus equity. This case also shows why companies must separate gross sales from actual revenue and match expenses with the correct period. My name is Diego Manco, and I hope you have enjoyed my video on Avengers Endgame financial situation. Thank you very much.